that
Sure.
I don't think it's that the Fed needs to cut rates. I'm on the camp that if the Fed cuts rates, I think that they're risking a mistake of reigniting inflation. I'm of the opinion that the rest of the economic indicators, even with the weak ISM employment statistic today, on balance, are painting an okay state of the labor market. Why is the unemployment rate rising? I think it's a simple answer that is very politically toxic to mention, and that is
We're speaking now with Jim Bianco. He is a president of Bianco Research, former market strategist at UBS Securities, and we'll be discussing his outlook on Fed policy, monetary policy, the economy, and markets. Welcome to the show, Jim. Good to have you.
thanks for having me.
Jim, let's start by talking about the Fed. After the FOMC decision to keep rates unchanged on Wednesday, we're speaking on Thursday, August 1st. I'm looking at the CME Fed Watch, so it's really interesting because now it's pricing in an 81% chance of a 25 basis point cut in September, and what appears to be a 20% chance of a 50 basis point cut by September. And now specifically, Powell was asked this question by a reporter at the press conference.
Jean Young with MNI Market News. Is a 50 basis point cut as a first cut at all likely or even on the table? Thank you.
I don't want to say, I don't want to be really specific about what we're going to do, but that's not something we're thinking about right now. Of course, I haven't made any decisions at all as of today.
But yet 20% chance. What's your read?
Yeah, I mean, that's what the market is doing. And let's back up here and remember that by my count, this is maybe the fifth time that the market is pivoted towards the Fed's done raising rates and they're going to start cutting rates. Well, they're done raising rates now, and now they're going to cut rates. The last pivot was, of course, January when the market got so sure they were going to cut rates. They priced in 6 or 7 rate cuts for this year. It looks like we might get the first one in September, so we're not going to come close to that. The market is getting ahead of itself. The point I'm trying to say with the 5 rate pivots is it does this about every 6 or 8 months. It gets ahead of itself and gets itself convinced that the economy's in deep trouble, that the Fed needs to rush to the situation and cut rates. A lot of the questions yesterday in the presser were, why didn't you cut rates today? If you wait till September, it's going to be too late. As if the economy's in immediate peril right now, that we have to do something to fix it. Somebody should tell the stock market, I know today was a bad day in the stock market. We're still only 3 or 4% off the all-time high that was set a couple of weeks ago. So that for the moment, the stock market doesn't seem to be overly concerned about the state of the economy.
What's your read on the state of the economy? Speaking of the state of the economy, Jerome Powell has mentioned that he needs significant cooling in the labor market before he's confident or comfortable cutting a rate by September. Are we going to get significant cooling in the labor market in the next 2 months, you think?
Yeah, so to answer the question generally, I tend to, we like to use the airplane metaphor, and I tend to consider myself in the no landing camp. No landing means that the economy is going to continue to grow at its potential, if not a little bit more. 5 of the last 8 quarters, it has grown above its potential, including in the second quarter. That is to contrast it with the soft landing camp, which is kind of mediocre growth and falling inflation, and the hard landing camp, which is a recession. So I'm in the no landing camp. I'm in the camp that thinks that the economy's fine and that there are issues. There are always issues with an economy. There's never not. But in general, it's fine. And my bigger concern is that if the Fed were to cut rates and stimulate an economy that's fine, they're going to reignite inflation. So I'm on the other side of the camp. I know a lot of people, Mohamed El-Erian and Bill Dudley, and some are saying if the Fed doesn't cut rates, they're going to make a mistake. I'm on the camp that if the Fed cuts rates, I think that they're risking a mistake of reigniting inflation. As far as the labor market goes, there's really one statistic that suggests that the labor market is cooling, really just one, and that is the unemployment rate has been rising for the last year or so. It's at 4.1%. If the next tomorrow, August 2nd, if it rises to 4.2%, it's going to trigger what's called the SOM rule, which means that we are in recession. Not that we're going to go into recession. That means we are already in recession, is what the SOM rule suggests. And Powell was asked about that yesterday, and he said, yeah, and the yield curve said we went into recession 2 years ago, and that didn't quite work out as well. So I'm of the opinion that the rest of the economic indicators, even with the weak ISM employment statistic today, on balance, are painting an okay state of the labor market. Why is the unemployment rate rising? I think it's a simple answer that is very politically toxic to mention, and that is the population of the country is rising faster than the demographers thought because of mass immigration over the southwest border. A lot of those immigrants that are walking over the border and seeking asylum are unemployed. They're getting picked up in the population data. The number of unemployed people is rising faster than the number of jobs that we have for those unemployed people because the population is rising, and that's why the unemployment rate's going up. As I like to say, the rising unemployment rate is a reflection of a changing demographic in the United States, not a slowing economy. And Claudia Sahm, the creator of the Sahm rules, even written about this herself and said, it's my rule, and I'm not so sure it's going to work this time. And part of the reason is the assumption in the rule is you have stable demographics. But when 11 million people come into your country in 3 years, and a lot of them are unemployed, your unemployment rate is going to go up. But don't mistake that with, oh, your economy must be weakening because you've got more unemployed people. And the reason I say that is the payroll report has not been weakening. It's been okay at 177,000 jobs over the last 3 months. That's not a bad number. It could be better, but it's 177,000 jobs a month for the last 3 months is nowhere near a soft landing or a recession. And so I think that the state of labor market is okay. And the last thing I'll say about the labor market real quick, I've been a big advocate of this, that do not discount remote work. Remote work has fundamentally changed the labor market in ways that we really are having a hard time understanding. For a lot of people, a job is transactional. I'll take this job, I'll do this job until a better opportunity comes along, or I've got enough money that I could quit and go do something fun, ski in the winter, go to the beach in the summer, whatever, floats your boat. And then I'll find another job when I need more money. That is more and more happening. That's why we have the gig work economy. That's why we have had these words like labor hoarding and quiet quitting. We've had employers have such a difficult time to get people back to the office full time. Point is that people keep telling me, well, that when the labor market does X, Y, or Z, and I think, yeah, that was 2019. This is the 2024 labor market. It doesn't work that way anymore. Now, I'm not going to tell you how it works. I'm just going to tell you, giving me 2019 rules on what the labor market is supposed to do, that doesn't work. I'm not exactly sure what the 2024 rules are. I just know that the old ones are not the right ones.
Before we continue the discussion, I want to take a minute to talk to you about today's sponsor, NordVPN. On this show, we regularly cover how to grow and protect your assets, but one of your most important assets is your privacy. Every investor needs to protect their digital privacy and footprint against hackers and potential viruses. According to Chainalysis, 2022 was the biggest year ever for crypto hacking, with hackers stealing $3.8 billion in cryptocurrency. And according to Duke University, more than 80% of U.S. companies claim to have been successfully hacked. One of the best ways to protect yourself and your privacy online is with NordVPN. Not only does NordVPN hide your identity online from malicious actors and criminals, but it also comes equipped with malware protection. NordVPN also prevents you from accessing dangerous websites, allowing you to enjoy your favorite financial content securely. And the best part is that it is easy to use. Just download and click. NordVPN is available for your phone or computer, and they're currently offering 65% off on a 2-year plan plus 4 extra months. Simply click on nordvpn.com/David Lin in the description down below to learn more. Well, you brought up remote work. That's not part of the unemployment numbers, right? They're still working. They're still collecting a paycheck, right?
Yes, and that's part of the reason why the payroll report has been staying so strong. I'll give you one statistic. 24 of the last 28 months, the payroll report has beaten Wall Street's estimate. It means there's a structural problem with Wall Street's estimate. They're always too low. Now we'll see if they're too low again, tomorrow with the July payroll report. The estimate is 175,000. But they've been too low. And that's because the nature of work has changed. that these people are turning jobs over a lot faster. The JOLTS report, people look at the JOLTS report and they say, yes, but it's been weakening the last few months, the JOLTS report, and it has. It's higher than any period other than the last 2 years. We've never seen this number of jobs or this number of labor turnover or this number of quits anywhere in history until 2 years ago. This is a very different environment. This is, like I said, if you took the JOLTS numbers that we got on Tuesday for May, 8.1 million open jobs, the number of people quitting, the number of, the labor turnover numbers as well, and you applied them to 2019, the answer would have been, this is a booming out of control labor market. But now we look at these numbers, and because we're in this mode that the Fed's got to cut rates, we think they're bad, but they're not bad. They're actually very good, is what they are. It's probably the best job market to be a job seeker that we've seen in many years. And it's not a very good job to be an employer. It's been harder to find good workers and retain good workers in this environment.
Okay, we're speaking on Thursday, so it's one day ahead of the unemployment numbers coming out on Friday. So we'll wait for tomorrow's numbers. But just today, the initial claims numbers came out, increased 14,000 to 249,000 jobs, or people rather. Bloomberg had this headline: U.S. initial claims rise to one-year high as hiring slows. I mean, it's pretty negative headline, but are you interpreting this news as just noise? I mean, it goes up and down per week, every time it comes out. So is it really as bad as it looks?
Yeah. So 249,000, up from about 210 a couple of weeks ago. Even that number is still near the lowest in 50 years. The 50-year low was a couple of months ago. So these are still very, very low numbers. You got to get to 350 to 400,000, I think, in order to really say that there's a big number. Now, what about this jump in numbers? Hurricane Peril hit Texas and Houston area on July 8th, and it caused widespread damage, which caused a lot of power outages. So a lot of hourly workers, if your business is closed because they got no power and trees are down and no one can drive, you're not getting paid, and you can file for unemployment insurance, even for 1 week. And so normally Texas would see about 13,000 people file for unemployment insurance initially every week. It peaked at 32,000 last week, 2 weeks ago. Last week, it was 25,000. So we're getting about 10 or 15,000 more unemployed or more initial claims out of Texas than normal. That's your rise. Is most of it, I think, is really coming from Texas. And then you can add in that there's been a spurt of claims for the retooling of the auto factories in Michigan. When an auto company shuts down in July or August, they usually shut down so they can retool the plant for the next year's car model. Well, all the line workers are unemployed for that 1 week. They don't get paid. They can go get unemployment insurance for 1 week, and they do. And so Texas and Michigan pretty much accounts for most of the rise that we've seen in unemployment. So it doesn't look like it's broad-based at all. It looks like it's more idiosyncratic over a couple of stories. And even if it wasn't, it is still a low number. And I'll throw out at you one more thing. It's the highest in a year. Well, what happened a year ago? The unemployment rate went to 3.5% and GDP boomed at 5%. So last time we were at 250,000 on unemployment, it wasn't an impediment to the economy. Like people somehow think that this one is. Again, I'll tell you, I'm a no-lander. I think the economy's fine. I think the narrative is we desperately want the Fed to cut rates. So we desperately have to find bad data, and we have to spin everything bad. And we have to work ourselves into a frenzy that the Fed has to cut rates, so much so that now we've put a 20% chance they're going to cut 50 basis points, because that's what Wall Street wants. It wants cheaper money, as opposed to kind of a cold calculating look at really what the state of the economy is.
Well, forget 50 basis points. I think you told CNBC a couple of weeks ago that, quote, there will be 0 rate cuts this year because I don't think they're warranted for the reasons that you've just stated. That was a couple of weeks ago. Are you still sticking to that even despite yesterday's speech by Powell? And he said a reduction in policy rate, rather, could be on the table as soon as the next meeting in September. Are those words significant?
I'm sticking with the second half of it, and that I don't think it's warranted. And that's why I've been at 0 all year. that
Sure.
I don't think it's that the Fed needs to cut rates. And the reason I don't think the Fed needs to cut rates is look at the stock market, look at the growth in the economy, look at the labor numbers other than the unemployment rate capturing the demographic shift in the country. And you see an economy that's fine with a 5.25 or 5.5% funds rate. You see an economy that's fine with interest rates, somewhere in corporate bond yields, somewhere in the 4 or 5% range. This is not retarding a lot in the economy because these are probably the close to normal rates. So the second half I'm comfortable with. I think the Fed should not be raising rates right now.
So
The first half, yeah, it looks like the Fed wants to raise. I'm sorry, the Fed should not be cutting rates. The
Yes.
first half, the Fed looks like they're intent on cutting rates. Okay, when you always talk about the Fed, there's what should they do and what will they do. I think they should do none. They will probably start cutting rates in September unless the data turns seriously bad from here. I think that would be a mistake.
suppose the Fed goes ahead and cuts rates by September, let's say 25 basis points. What's that going to do to the stock markets?
Well, it's going to do a lot for the stock market. It depends. It really depends. There's two scenarios that you can paint on that. First of all, the assumption is with the Fed, they go in September. It is the beginning of a campaign. There's no we're going to cut rates once and then wait 6 months and see how things go. There's going to be none of that. The market thinks, no, you're going every meeting. Whenever you start, it's the beginning of a campaign. So there's going to be a campaign towards lower yields. What's the stock market's reaction going to be to it? If the market thinks if the market's in the no landing camp like I'm in and thinks the economy's fine, it takes off. Thank you, Jay. You've just given me cheaper money. It's, you've taken my 5-year-old and you've loaded them up with candy and sugar. And that's what you should expect out of the stock market if it's in the no landing camp, which is where I'm at right now. But if the data turns, and it turns seriously south, then a rate cut is going to be perceived as a bit of a panic to try and stave off a downturn. And the Fed's track record, whenever they start to panic to try and stop a downturn, is they almost never do, and we wind up sinking in the recession. And then in that case, the stock market's reaction would be poor. So I'm going to be on board with this idea that it's probably going to be positive. On balance, what you've seen out of the stock market is probably more better data than poor data. Yeah, the S&P peaked a couple of weeks ago, and it's a couple percent off the high. But the small cap stocks took off in this gigantic rotation, and we've seen that this has been viewed positively. The last thing I'll give you on this is about the Fed. The watershed moment was July 11th. July 11th was the June CPI report. It came in at minus 0.1%. That was like the alarm bell went off. The Fed's going to cut rates. Here comes cheap money. Let's go. Volatility kicked up. The rotation took place. The bond yields on July 11th were 4.50. Today, they're under 4% 3 weeks later. So everything changed on that CPI report. Bloomberg today has a story now that even on earnings calls for the second quarter, which are getting reported now, the word Fed is being mentioned more than ever before. Everything, the center of the financial universe is about whether or not the Fed's going to make money cheaper. Everything revolves around that. And the starting gun for that was that cheap or that low negative CPI report. If the data really turns bad, and I mean seriously bad, then that will elicit probably a bad reaction out of risk markets. But if it doesn't, we're just going to probably see a sugar high out of them.
I think that's probably America's signal to stop spending money if they want lower rates for the next 2 months. If consumers just stay home, they're going to get what they want. Okay, let's talk about this rotation that you mentioned. So the Russell, yes, you're right. On June 11th, huge surge in the Russell, and then rotating out of the Mag 7 tech stocks. Now, it looks like today on Thursday, August 1st, everything's down. I mean, by everything, I mean the large cap tech stocks are down, the Russell's down, and I'm looking at Bitcoin's down as well. We can talk about Bitcoin. So what's happening right now?
Yeah, the rotation, the big rotation on July 11th, as you mentioned, was everybody out of Mag 7, everybody out of big cap, everybody in the small cap or the S&P equal weight. and you had this gigantic surge of small cap stocks, and that came to a crashing halt today. Now, from a bigger picture, has the market technically broke down? Is it suggesting something ominous? Not really, because it was up big yesterday and it's down big today. What we've seen is a massive expansion of volatility. For starters, what usually leads to an expansion of volatility? When a market becomes single focus narrative. The single focus narrative right now is, will the Fed cut rates? And so whenever you get the market on one idea like that, you tend to get a lot of volatility. The rotation trade has always struck me as being very speculative. And because of it being very speculative, I think what you've seen is one of the biggest run-ups. I mean, the outperformance of small cap to large cap over the last 3 weeks is the biggest ever. And data goes back to the mid-70s on this. So I'm not surprised if you had the biggest run-up ever, you had the biggest one-day reversal ever, and that we're going to continue to see all of this wild volatility because we're all going to be focused on one thing. What's the Fed going to do? What's the payroll report going to say? How does that impact the Fed for September? And that's why everything seems to be driven by this one idea. So I don't think the rotation's over yet. But I do think we've now entered the phase where it's going to be very difficult to play the rotation trade because you better be prepared if you're going to go from small cap to large cap or vice versa, that it used to be that one would outperform the other by 10 or 20 basis points, 0.2% a day. Now it's they outperform by 200 basis points or 2% a day, 10x more volatility than you used to. So I still think the rotation trade is probably there towards small cap, but be careful because a whole year's worth of underperformance or outperformance is going to come and go every couple of days because that's the type of environment it's become now.
Over the last couple of years, if you just take a look at the Russell versus the NASDAQ over the last couple of years, it's still underperformed the large cap. So how are you reading this? Would it be still okay, I guess, to position ourselves long Russell versus large cap tech stocks?
Yeah, because over the last couple of years, the stock market has basically been 7 stocks, the magnificent 7 stocks that are all
Sure.
sort of affiliated with the whole AI boom. And that seems to be really, when it comes to the stock market, it's like you've got 8 choices. You've got 7 stocks, the Mag 7, and then you've got small cap. That's basically what your choice is. I think really why we got the rotation was this idea that maybe if the Fed cuts rates, lowers borrowing costs, that would help kind of the non-AI companies. Microsoft doesn't need cheaper money. Apple doesn't need cheaper money. Google doesn't need, or Alphabet doesn't need cheaper money. But most of the companies in the Russell 2000 could really benefit from the idea that we have cheaper money. So that's why I think you had the rotation into the small cap stocks. As far as the AI boom goes, I think it's at an inflection point to the extent that we have so priced in this transformational AI coming that it has to happen. As I like to say, when I look back, I was on Wall Street in the late 90s when we had the internet boom. And I read Wired magazine and everything else about the wonderful things that the internet was going to usher in and just be culturally changing and everything. And it was right. It did all of that, except it took 20 to 25 years for that to really come into fruition. But the way Wall Street priced it by late 99 was they expected we would have Twitter with 4 billion users and Facebook and Amazon being one of the largest companies in the world. By 2002, they expected it to happen that fast. Well, look, Twitter wasn't even invented until like several years after that. So the problem with the AI thing is, will AI do everything that its promoters say it will? Yes, and probably more. Will it do it by 2026? Because that's what the market is expecting. Or might it take 10 more years or 15 more years for it to really take hold like we think it will? Well, if it does, there's going to be a big disappointment in those stocks because they've priced in this productivity boom from these companies now. Not that it's going to come somewhere in the future. It has to happen now, just like what we saw with the internet stocks in the late 90s.
So you're comparing what's happening right now with the late 90s? Are you saying there's a tech bubble?
I think there's an AI bubble. There's no doubt that there's an AI bubble. There was a tech bubble in the late 90s and it blew up and the stocks went down 80% and then they made new highs. I mean, if you look at the NASDAQ, it's 3 or 4 times higher than it was in the 2000 peak 20 years later. But there's a lot of similarities between the late 90s and now. Where we are in that cycle, you can argue, but what you're betting on with the AI stocks is if you buy those AI stocks, don't tell me the wonderful things it's going to do. I agree with you. It's going to do that. Is it going to happen by 2026? Because that's what's been priced in. It's got to happen now. You can't tell me, yeah, it's going to happen. It might take 8 or 10 years. Well, then the stocks are overvalued. If it's going to take 8 or 10 years, if it takes 2 or 3, then they're appropriately valued. That's really what the question is with these AI stocks.
What do you think about this chart? I showed you this offline. I'll show it for the viewers once more. Cisco versus NVIDIA. Somebody overlaid NVIDIA with Cisco. And it looks like right now NVIDIA is at where Cisco was at before it busted pre-2000. And, it's just a comparison visually. But are there any fundamentals to illustrate the point that
Yes.
Cisco and NVIDIA are, NVIDIA's future is going to be like Cisco's?
One of the more overused phrases on Wall Street is the picks and shovels play, that everybody wants to do the picks and shovels play. Well, in late 99, when we said, look, the internet is coming, everybody's going to get an email address, everybody's going to be, surfing the web, there's going to be millions of websites. The picks and shovels play was the servers that drove the internet, which was Cisco servers. Picks and shovels play for AI right now is the semis that NVIDIA makes, so they're at very similar points in what they provide for AI and what they provided for the internet, and they're very similar types of concepts. I don't know what the content providers are going to be. As I pointed out to you, in the late 90s, Google didn't exist. Twitter didn't exist. Facebook didn't exist. But we knew that something tremendous was going to come. And they all needed these servers to drive that. And that was the Cisco play. Well, that's the NVIDIA play right now. We don't know what AI is going to do, but everybody's going to need NVIDIA chips to drive AI. And eventually the content producers that will come later, and they will make all of the wonderful things that we will use. Well, the picks and shovels plays tend to be the early movers, and they tend to, and when you get mid-cycle, that play is over. Look, if you look at Cisco, it's barely above its 2000 high. Here we are 25 years later. And that's the risk that an NVIDIA takes. Yes, thank you for those chips, and we're going to keep buying those chips. And, your stock might find itself peaking fairly soon and not go any further, because eventually we're going to say, what are people doing with those chips? And I want to invest in those companies that are doing things with the chips as opposed to the chip maker. So it is very similar. The concept of where Cisco was to the internet and where NVIDIA is to the AI boom. And that's why that chart gets such good play. Now, the way it's drawn suggests that the high is like in NVIDIA is right now. Maybe it is right now, but I know with overlay charts, you could tweak those a little bit. And you could say that the high is right now, or it's still got another 6 more months. But the concept is definitely sound.
Is this predicated on cheap money, the continuation of high valuations on tech stocks, or are they independent of Fed policy?
Is it predicated on cheap money? Yes, but not on valuations. It is. Where it's predicated on cheap money is if you look at the flows in financials, in investment flows, you will see that fixed income has been getting huge inflows between money market funds over 5% and bond funds. Trillions with a T dollars is flowing into those asset classes. Why? Because for the first time in 40 years, there's a yield. There's a yield of 5%, in some cases 6%. If you're talking about some certain corporates or high yields or structured notes or something like that. We haven't seen those type of yields in decades. And investors are looking at that and they're saying, what is it that I should rationally expect to get out of my investment portfolio? Well, The rational expectation should be about an 8% return a year. Well, if it's 1999 and you want to get an 8% return and money market funds are at zero and bond funds are at 2%, everybody screams Tina, there is no alternative. And they all pile in the stocks. It's 2024 and there's a 5% money market fund and 5% bond funds. Then people say, you know what? I'll take 65, 70% of the at 8% with very little risk, no risk if you're talking about a money market fund, and just I'll take that. Thank you very much for a big part of my portfolio. So if you cut rates, then Wall Street could start screaming Tina to trillions of dollars in bonds. You're not going to make any money there. There's no yield. We got to get everybody out of the pool. Let's go back into stocks and shove all that money back into the stock market. So it won't help with the valuations, but it can help with the investment flows.
Let's talk about yields. So you mentioned the yields have been falling. Again, now is this a longer term play on the decline of either economic growth or inflation outlook, or is this correlated with the expectations that the Fed funds rate may fall soon?
I think it's the latter. For now, I mean, over the last month or two, it's correlated with the idea that the Fed's going to cut rates and there's going to be a parallel shift down in the yield curve. In other words, if short-term interest rates fall, that will drag longer-term interest rates down as well. Longer term, I think that the 40-year bull market in bonds ended in 2020 when the 10-year yield hit 0.5%. That's hard to believe, but it was 4 years ago. That it actually hit 4 years ago this week, actually, it hit 0.5% on its yield. And that we're in a secular increase in interest rates right now. It peaked so far October last year, the 10-year yield at 5%, slightly under 4. It's at the lowest level since February, as we're reporting right now. But even with that decline, the trend has generally been higher for the last 4 years. I think over the next several years, the trend is going to continue to be higher. Why? Because I think it goes back to I think we're in a no landing scenario. I think the inflation rate is not going to go back to 2%. I think at best it bottoms at 3. It only goes back to 2 if we have a recession, and it only stays there for as long as we have a recession, and then it bounces back. If the Fed cuts rates, stimulates, you might even get more inflation, and that will eventually lead to higher interest rates. So I think that, from a bond investor standpoint, this is a different world than we're used to. It's a great world for bonds because there's a yield and there's a competitive yield. And there's a lot of people who are saying, look, I'll just take that 5% yield and I don't need to speculate in the stock market.
Here's a scenario. Sorry,
yep.
Yeah, please. I was going to say, so suppose the Fed cuts and then inflation either stays elevated or perhaps even ticks up, like you suggested it might. What would the Fed do in that case? Would they raise rates again just to combat higher inflation?
Well,
yeah,
I think it all comes down to the bond market. If the Fed cuts and it stimulates inflation, and the bond market has a toxic reaction to it, and that's a nice way of saying yields go up a lot and they go back up near 5%, then I think that the Fed will have a severe credibility problem. They did this 3 years ago when they started mumbling the word transitory about inflation and went to 9%. And then they had to catch up by raising rates 75 basis points a meeting. But if that happens again, and that's why I said the Fed's risk is you raise rates and we get more inflation. And that seems to be the one thing that a lot of people have really written off. Oh, no, inflation's gone. It's a non-issue anymore. It was transitory after all. And like I said, I don't think it is. But if that's what happens, I think then the Fed might be forced to reverse. And it will be forced by the market to reverse. So that's why it's a very risky scenario. Now, look, if the Fed cuts rates and it stimulates the economy and the stock market goes up and it stimulates spending, it stimulates hiring, and that does not improve or does not, cause inflation to go up, then they did quote unquote, stick the soft landing, to use an Olympic metaphor, in this week. And they deserve the kudos that they would get if that is what indeed happens. I just happen not to be in that camp. I'm worried about inflation staying at 3 to 4%. And if you're going to stimulate the economy, it might be closer to 4 than 3, as opposed to that we're in a soft landing scenario.
If your view is that the 10-year may stay elevated or perhaps go up even more. So are you expecting bonds then to have a pretty bad year going into 2025?
Well, bad year is a relative term. In 21, 22, and 23, collectively, those 3 years, the bond market had its worst total return ever recorded. And Ed McQuarrie of Santa Clara University has data on bond total returns into the 1790s. And the three worst years to have ever owned bonds was 2021, 2022, and 2023. And that is very fresh in everybody's mind. Why? Because we needed to go from a zero yield to a 5% yield, and getting there meant tremendous pain and a big fall in the price. We're there now. We're at a 5% yield. So if yields go up from here, you could still end the year with a positive return in the bond market. You could still end the year with a 2, 3, 4% return if you just invested in held bonds all year, because you're starting with getting a 5% coupon. In 2021, you started with no coupon and you just took losses, is what you want on the price falling. So it is a much better place, but it took tremendous pain to get the bond market where it is today. But now that it's here, it is offering a competitive rate if you still believe that an 8% a year return all in is what you should expect. Now, in the crypto crowd, they expect that every day. The tech crowd expects that every month, an 8% return. That's probably not realistic. But if you could say a big chunk of my portfolio here, it's done, it's going to give me 5. And then I could go reach out and do some other things to try and augment that to get it up near 8. And that's a goal. That's not a minimum threshold. Then I think that the bond market, can still be competitive, even though we were going to be a rising rate environment. Look, what I'm arguing is what we saw in the 70s and 80s with the bond market, especially in the 80s. That people are still thinking about bonds like about with the 60-40 portfolio like they did prior to 2020, when we had no yield and we had a very different environment with the bond market. But this environment's different now that there's a yield. It changes a lot of things.
Any sectors in the S&P 500 that you're particularly more bullish on?
Bullish on in terms of the S&P, I probably say that I think the small cap stocks, admittedly, that it's going to be tremendously volatile to own those. I like those. As far as the industry sectors go, I'll start off with I'm not a fan of the financials. I think the financials are ripe for disruption, probably from digital and crypto. And their cost structures are all way too high. I think that they're at risk. The problem I have with tech is it's overvalued. It's a good idea, but you're paying up for it as well. So other than that, I would probably say energy and consumer cyclicals. Energy, because I think there will be a rebound in energy. I think what's depressing energy right now is the economy in China is not in a good place, and that's really sapping worldwide demand for energy. But I do think China might be getting near a bottom, and it might start picking up, and that should help boost energy prices. And cyclicals, if you're in the no landing camp like I am, and the economy is going to grow, then consumer cyclicals would be a good place to be.
Let's switch gears now to Bitcoin. Bitcoin is trading currently, speaking right now, around $64,788, $65,000. You tweeted this on July 31st in response to Donald Trump's announcement at the Bitcoin conference in Nashville. All government reserves, you said, whether the dollar, oil, cheese, or even cars, remember cash for clunkers, usually cause more harm than good. Why would government interference in Bitcoin via a reserve be any different? I don't understand why the Bitcoin community wants this so badly. So why is this so bad? Why is this a bad idea, Jim?
Because the Bitcoin community thinks that the government is going to, let me say it bluntly to get my point across. The government is going to borrow government bonds. They're going to sell government bonds, and they're going to raise interest rates because there's going to be more supply. And that is going to cause mortgage rates to go up. And that's going to cause people that are struggling to meet ends to make it more difficult for them to buy houses. And then they're going to take all that money and they're going to plow it into Bitcoin, and they're never going to do or say anything to the Bitcoin community. No, we're just going to buy it. We're just going to hodl it for 50 years, and we're going to see where it goes after that. Cynthia Lummis has got this idea that we're going to buy and hodl it for 50 years, and then it's going to rise so much, it's going to pay off the national debt. And I'm sorry for you, people that are struggling to make ends meet in 2024 that you can't afford a house, but we need to buy Bitcoin. Now, I say that sarcastically to get my point across, that every time the government steps in and does something like this, they put rules on it. They're going to decide what is the appropriate price for Bitcoin, and they're going to sell it when it's too high. They're going to buy it when it's too low. They're going to decide who owns it. They're going to put all kind of rules and regulations. Do you think when we buy gold or we buy oil or we buy cheese, because there is a national cheese reserve to help the dairy farmers in Wisconsin, or when we bought cash for clunkers, that we just bought this stuff, no questions asked? No, we put a lot of rules and regulations and constraints on everybody involved in those industries. If you want the government to come with its money and buy your stuff, it puts rules on you. And at the end of the day, those rules do more harm than good. I think I'm a fan of the crypto community. Crypto community wants to be an alternative, wants to have self-sovereignty, wants to be something that is going to lead to freedom and personal responsibility. The last thing you want, if you believe that, the absolute dead last thing you want is to get in bed with the government and have the government put rules on you. It's a bunch of number go up tourists that just want the damn thing to 100,000 now. And they don't care about why or how it gets there. Just get it to 100,000. That's all that the people that think that this is a good idea. In the long run, I think this is a bad idea. I think there's enough level-headed people in the Bitcoin community that would probably agree with that it's a bad idea as well. So I'm not a fan of this whole idea that the government is going to buy crypto. Like I said, I can't emphasize enough. They're not just going to buy it, and they're not going to let you hold it in a self-custodied account. And then when Liz Warren is screaming that you're driving up the price, so all of these drug dealers that own their crypto in a self-custody account get richer, while somebody in Waltham, Massachusetts can't afford a house because you've borrowed all this money to buy Bitcoin, and you drove up interest rates. That ain't going to fly for 3 seconds. The government's going to come with all kind of heavy-handed rules on crypto. So be careful what you wish for.
They could also dump Bitcoins from the strategic reserve like they did with oil. So, I mean, that in theory, they could drive down the price if they wanted to with that.
Yes, they could. They could. And, and even though Donald Trump says that they would never, ever sell it, it's like everybody forgot 8th grade government class, right? Is it a law? Did they pass a bill in Congress? Then did the president sign the bill that they will never, ever sell it under any circumstance forever and ever? Amen. No, they will never do that. Donald Trump will just say, we don't intend on selling it until circumstances change, and then they will sell it. And then you will have a lot of government selling. I think the best reserve that the government holds with crypto is zero, and that they're not involved in it at all when it comes to trying to manipulate the price.
Speaking of Senator Loomis, this is her Bitcoin strategic reserve legislation that she introduced yesterday on 31st of July, established a decentralized network of secure Bitcoin vaults operated by the United States Treasury, implement a 1 million unit Bitcoin purchase program over a set period of time to acquire a stake of approximately 5% of total Bitcoin supply, mirroring the size and scope of gold reserves held by the United States. Be paid for by diversifying existing funds within the Federal Reserve System and Treasury Department. You just talked about that. Affirm self-custody rights of private Bitcoin holders and emphasize that the strategic Bitcoin reserve shall not infringe upon individual financial freedoms. Okay, so my first question is, how did they come up with the 1 million unit Bitcoin purchase program? The size. Why does it have to be the size of the gold reserves? I mean, is there a practical...
I don't know.
Okay.
Yeah, I don't know. I'll say that there's a lot of good in there. When you went through those bullet points, the last set of bullet points was very good. But the first one was almost a non sequitur. To have the government establish a decentralized self-custody, the government cannot establish decentralized self-custody. Those two things don't go together. And it's like there's a misunderstanding of what decentralization means. The government's going to set up a decentralized account, and then they're going to give themselves a back door. If you're a naughty player, then they can come in and take your coins away from you. Don't kid yourself. That's what's going to happen with that. So you don't want them in there at all. The 1 million coins is 5% because it's what they own in gold. I don't know why the gold, the amount of gold that they own needs to be the metric. By the way, as far as gold goes, the Federal Reserve's and holding of gold has been effectually unchanged for many, many decades. They acquired it before all of us were born under the gold standard. Remember that the reason that they own gold, they didn't buy gold to boost the price. They bought gold because it used to back the dollar. For every dollar's worth of gold they held, they would issue $1. And you could take that dollar to the Fed and say, give me $1 worth of gold for all of these dollars. That's why they own the gold. And then we went off that standard, and then they just held it forever. We're not going to go to some kind of standard where the government is going to buy Bitcoin and then issue some kind of government-backed CBDC backed by Bitcoin. There's no talk of that. So I don't understand what is the purpose of this Bitcoin reserve other than for naked manipulation to just make number go up. And that's not a good reason for them to do it.
Well, that kind of was my next question. The purpose of this. I mean, the gold served a purpose for the strategic reserve. The other commodities you mentioned, petroleum has a purpose to use in times of disaster or wartime.
Yep.
What are they going to use this Bitcoin for? If
That's
anything?
a good question. You're absolutely right. I mean, they acquire this stuff for even the cheese reserve. The cheese reserve that they did to support dairy farmers, they take that cheese and then they distribute it to low income kids in their school lunch programs. So even that has a purpose too. So you're going to acquire 1,000,000 Bitcoin for what purpose? To just have a cold storage wallet sit there at the Department of Treasury and do nothing with it forever and ever and hope that its price goes up a lot and that the government has an unrealized gain? The government's never done that. And there's a lot of people that would argue that getting involved in a private sector enterprise to that, why do you think they've never bought stocks to this day? That the Social Security Administration is not backing all of our retirements with stocks? Because the fear has always been that if the government buys stocks, hey, now we've got these proxies and we get to vote these proxies. And now Congress gets to tell corporate America what it wants it to do and not do through the voting of proxies. And that's why we don't want government to own stocks, because they get involved in these things and we don't want them involved in the private sector. Why you want them involved in Bitcoin is beyond me. Now, look, a lot of the other parts of her bill I really like about, some of the other, regulation and a lot of the other rules that they want to set up about Bitcoin and promoting the idea of letting the private sector create self-custody. That's all good. But this idea that the government is going to just, is going to be the biggest hodler of Bitcoin in the world, I think is a very, very dangerous idea.
Bitcoin's price is down today. This follows a sell-off in tech stocks. All equity sectors, really, mostly. And people were wondering why the price didn't respond positively, or at least sustain their positive momentum following Trump's speech. Does it look like that Bitcoin is still just trading like a leveraged play on the tech stock sector right now?
I think it is. I think it is. I think you got to really start worrying. Look, the all-time high in Bitcoin is $74,000 in March, right? So we're now approaching 5 or 6 months since then. What's happened since March? You've had the halving. You've had the big boom in the ETFs. You've had Trump go out there and give you everything you wanted. Bitcoin community has gotten all the positive news it could ever want. And all of the big positives. I mean, if you ask Bitcoin people, the two biggest positives of the last couple of years is we just had the halving in April and what Trump just said at the speech last week in Nashville. And we can't make a new high. And that's got to be very concerning. You've already pumped in all the good stories, and it can't really make some kind of a high. And so I think it is concerning that maybe the adoption rate is slowing down, or something else is getting in the way that is preventing it. And it doesn't work that here's a piece of good news, and then a market just sits there for 6 months and does nothing. And then everybody has an epiphany 6 months later and goes, oh yeah, that news back in April was really good. We should start buying it today. Markets don't work that way. They respond, they anticipate good news. They don't wait months after good news. So when people say all this news is going to get the price of Bitcoin to 100,000, I said it should have been there 2 months ago. And the fact that it isn't should be a concern that something is not working right, at least with the price. And we'll have to see. Now, I happen to think that part of the problem is that there's too many number go up tourists, as I like to call them in this stuff, that are just basically, in there for a trade. And there's not enough hodlers, there's not enough development, there's not enough longer term vision as to how do we build a new financial system on these blockchain rails. And that's really where we got to get back to. And when we get back to that, we can really then start to see these prices go. But if all we want is Cynthia Lummis to buy 1 million Bitcoin, and all we want is just basically to tell all of TradFi, you got to dump all your money into the BlackRock ETF, that ain't going to get you there. And how do I know it ain't going to get you there? Because it ain't working now. And it's been 6 months since we've had an all-time high.
Okay, so final question on Bitcoin. We'll close it here. So people have been speculating that perhaps a Republican win could be more bullish for Bitcoin. So ultimately, it doesn't matter who's president, Harris or Trump. That's my question. Because if we're talking about government attitude towards Bitcoin, certainly regulations are important, but is that really the most important driver for the price?
No, I think that the Bitcoin community, unfortunately, has made themselves a partisan issue. That Bitcoin has effectively become kind of a Trump election future, and to some degree, and that is a concern. And there's people that have been actually arguing that, if you look at the polls and you look at what's been going on with the U.S. presidential election last Saturday, we all got excited because Trump was going to be president and he was going to be very pro Bitcoin. Well, 5 or 6 days later now, we're not so sure he's going to be president. And I'm not saying he won't be. It's a toss-up race now. And that maybe that's been a problem. Okay, that makes sense. But then again, that's a self-owned goal by the Bitcoin community. You decided to take your decentralized, nonpartisan product, the blockchain and Bitcoin, and you made yourself partisan. You tied yourself to a political party. Not that you tied yourself to the wrong political party. You tied yourself to one of them. And now you've got to have to suffer through those consequences. I know Mike Novogratz is out saying he thinks that Kamala Harris is going to come around and be pro-Bitcoin. That's wishful thinking. There is zero evidence anywhere in the Democrat Party that they are interested at all in being pro-crypto. I understand Novogratz is a liberal Democrat. He wants to donate and vote for liberal Democrats, and he needs to justify that by saying that the Democrats will be positive, and Kamala Harris will be positive for Bitcoin too. Yeah, and I'm going to win the lottery next week. I mean, it just isn't going to work. I mean, that's wishful thinking if it happens at best, and probably naive thinking at worst.
Isn't the justification is that they need to be? I mean, 50 million pro crypto, investors in the U.S. It's become for some people it's a single voter issue, or a single issue.
Well, if they're not,
they're single issue voters. That's what I meant to say. That needs to incentivize the Democrats to do something.
Yeah, I mean, that is a good issue. I mean, that is a good point. That if there are 50 million crypto users and a lot of them are single issue voters, that the Democrats should saddle up to them. It's August 1st. They haven't done it yet.
Okay.
No, they haven't done it yet. They've made no noise that they're going to do it. So that should have happened months ago. Gary Gensler is still the chairman of the Federal Reserve, of the Securities and Exchange Commission. Liz Warren is still an important voice in the Democrat Party, and she's the one who's campaigning on building an anti-crypto army. So, yeah, I would argue that it probably does make political sense that they do. But the fact of the matter is, Kamala Harris was invited to the Nashville conference, and she turned them down. And so, therefore, why do we think that they're going to come? They're not there yet. They haven't been there. They've been hostile to Bitcoin for 4 years. And I just don't see, like I said, I think it's wishful thinking to think that they're going to just pull this massive 180. And even if they do pull this massive 180 in September, how do you know they won't pull a 180 back at you on Wednesday after Election Day if they win? That's the real issue that you have to face with. So, yeah, they should if it would make them more politically palatable, but the fact is they haven't.
Jim, excellent talk. Thank you. Where can we learn more from you?
So 2 ways, BiancoResearch.com, or you can follow me on at Bianco Research on YouTube or on on X, or Jim Bianco on LinkedIn under my name. And also we run an ETF. It's a long-only fixed income ETF. I'll just say WTBN is its symbol, and you can find out more about it at biancoadvisors.com.
Okay, we'll put the links down in the description down below, so make sure to follow Jim there. Thank you very much, Jim. We'll speak again soon.
Thank you.
Thank you for watching. Don't forget to like and subscribe.